So hi everyone. So we are into the month of Feb now, and a very important event for the market, that is the budget outcome. We have already seen on 1st of Feb, and afterwards market has reacted to it, and certain sectors will start now shaping up eventually, looking at the outcome of the budget. And as we are moving into 2023, so we have state elections also, and then the primary election in the next year. So all of these things, will remain in the highlight, and amid this, market movements, will remain. The volatility of the market can remain higher if any geopolitical crisis remains. For the time being, what we are observing, that the things are cooling off. The FI money has started coming actually into the emerging markets at least, and we have seen that it has gone into Hang Seng, so which moved up by more than 50% since the month of October. Indian market valuations were relatively expensive to the emerging markets, so Indian markets are into more time correction mode, and so certain pockets in emerging markets where more value was there, those possibly can see the FI flows into in the coming days. And India also, once we have already seen more than 1,000 points of correction now, so eventually we may come below now the 5-year average price to earning, and then Indian markets also will start getting lucrative. So if you see now, what is the canvas on the overall global market? So dollar index is still subdued, which is eventually happening because of the lower inflation. Interest rate trajectory also is getting slower. It looks like it may top out in 2023. European gas prices also in Europe, because that was a problem area in the second half 2023, that has cooled off. Still, it is higher from the previous trading prices, but at least from the higher levels, it has cooled off. If you see the Brent crude prices, because still we are seeing the prices are subdued, it moved up to almost close to $88-89, but now again it is close to $80. So crude prices are subdued. In fact, you would have seen that there is a news flow that from 5th of Feb, the diesel and petrol, the refining products actually, so Europe has put a ban on these products also from Russia, and it is $100, $100 kind of pricing which they have kept. Like for crude oil, they have kept the pricing of $60. For diesel and petrol, they have done it actually 100 now. So this is where overall trajectory of crude and the refined product, it looks like the cracks also have started coming down. I was looking at the cracks in Europe, so they have actually come down from 36 to 27 now. So because of this, we believe that this particular subdued nature of crude can continue in the coming days. So when we look at the yield curve inversion in US, it is still there. When you see the difference of 2-year and 10-year yields, it is still around 74-75 bips. So that means when we were projecting the recessionary trend in US because of the yield curve inversion, still it has not been off. It is still there. So that means the commodities which came down because of this slowdown nature, it looks like that the commodities possibly can continue to remain subdued. Now, there may be very few commodities which can start moving up. For example, some industrial metals can perform because China is opening up, and that can lead to some kind of reversal there. So that is a very interesting thing which we have kept on watch. It is possible some metal stocks can start participating if the industrial metals see some kind of reversal. Now, this is important because amid all the things, our budget came out on Feb 1st, and we saw that there are 7 major priorities of the government. One is inclusive development. So they are talking about on 4 pillars: regional, economic, social, as well as gender. So they have come out with a women empowerment also in this budget. They are talking about the economic growth and they want to make it more inclusive. And that is where they have done something for poor, they have done something for agri, they have done something for MSME also in this budget. Not only that, the higher tax of HNI category also is reduced to some extent. So overall, it looks like the government is looking for an inclusive development now. Reaching the last mile is another pillar or priority of this budget, and we have seen that the government has done some kind of credit exposure, increasing that exposure to the agriculture area, because overall the farming in India has remained quite subdued because of the impact of high inflation. So that is where the government is trying to, rejuvenate that particular segment of the market now. If you see the infrastructure and investment, obviously this is something from the last 2-3 years, the major impetus has gone into infrastructure and investment by the government. In financial year 20, we had 1.6% of GDP kind of investment in Capex, and now it has increased to now almost 3.3% of GDP. Unleashing the potential, it's a very interesting thing that government now is focusing on tourism. They are talking about 50 nodal centers to be opened. They are saying that the job creation through manufacturing is one, but job creation through tourism is another focus of the government now. And that is where the diversity of India, they want to portray now to outside world more and more. And this is where many ancillary sectors may have a good time now because of this push from the government. Green growth is another feature where the energy transition is continuously being in focus. We are seeing whether it is an alternative to fossil fuel, which has worked upon, whether it is ethanol, whether it is EV, whether it is solar, whether it is wind, and now green hydrogen. So the government is continuously allocating some funds now for this, and they want to build up some kind of renewable setup now, very substantial setup by 2030. Already, our contribution actually in this segment has been quite significant already now. The youth power, obviously, this is something where our demographic comes into play, where we have more youth in our population. And this is where the government is focusing, and skilled, unskilled, both kind of developments they are trying to build upon. So when they build upon the infra development, there is the unskilled part actually, which is very huge in number in India. So they provide to give employment actually through this infra development and all. So manufacturing and tourism are the other areas where we believe that this particular segment will get more employment now in the coming days. Financial sector. So when we talk about inclusive development, obviously the financial sector plays a very vital role, and it gives, the credit to the corporates, it gives credit to the individuals, it gives credit to MSMEs, and that is where you see that the further growth comes in. So liquidity is all positioned through the banks and NBFCs in the market. So that is how these 7 priorities budget is positioned on. And then let us see how much allocations are done now. If you see in the Capex category over capital expenditure, we have seen a much higher than market expectation kind of figure, because market hardly was expecting that 33% of jump will come. Market was mostly expecting 15-20% of surge. But this time, again, they have gone with very high allocation to infra. So almost 10 lakh crore allocation has come, which comes to 3.3% of GDP. In fact, government has continued the 50-year interest-free loan exposure to the states, and that allocation also has increased by 30,000 crores from 1.1 lakh crores to almost 1.3 lakh crores now. So this is where this is something which will drive the capital goods, which will drive the infra, which will drive banks actually going forward. Or 2 years, we believe that the government they don't want to lose the momentum here. So whether it is an election or non-election year, this particular move is likely to continue in many sectors now related to the Capex. If you see the segmentation of this Capex, when they are talking about 10 lakh crores, the major is going into three segments. One is railways. So in railways, we have seen in financial year 23, you had 1.6 lakh crores. Now it is 2.4. It is 50% jump, which is the highest jump we have seen in the railway Capex. In the roads, it was 2.08 lakh crores. Now it is close to 2.6. And we have seen that it is a jump of almost 25% in this segment also. When you look at defense, we have 1.6 lakh crores now, the overall allocation. It has increased a little lower than the market expectation, which was around 8%. Market was expecting much higher. So that is where we have seen some profit booking in those PSU stocks, which were the prime beneficiary of this allocation in the budget. But still, there are some private companies which are emerging in defense. And we believe if they have a good base in the last 10 years, those stocks can start participating now. That is what we believe. And this is what we are positioning in our ACE equity portfolio, which is our flagship product. When you look at green energy, I already discussed that the government is trying to build up here. So they are talking about 8,300 crores of assistance to the Ladakh renewable project. And this is where, if you look at the overall value chain in the green energy, so it's a total investment of around 20,000 crores now is already done. So this is something on regular basis is coming out from the government. We have seen some private players have also announced the Capex in green energy now. The large corporates, they have announced this particular Capex. If you see the bond yields, they have remained subdued. They have remained subdued because the government borrowing actually has not increased. So they have kept the fiscal deficit glide path very clear that they want to bring it down. And that is where actually the borrowing is not increasing. So they are trying to get the revenues through taxes. They are already getting good revenues, or you can say they are able to save the money through the discounted crude oil that they are getting from Russia, which is almost 30% now. From March 2022, where it was almost nil, now it is 30%, which is very significant. Government is getting this crude actually at $60 or below that particular price. So this is a good saving for government now. And that is also one of the prime reasons that the borrowing is not increasing, which is good for the bond market. And this is where eventually this is good for some of the PSU banks also, which have huge holding of government securities with them. So disinvestment targets, if you remember last to last year, it was very close to 2 lakh crores. It did not happen. Now the government is getting more practical because they understand the complexity behind the disinvestment process. Last year, they had 65,000 crores of disinvestment, but now finally it is also brought down to 51,000 crores because it did not happen. Now for the coming year, coming financial year, they are talking about 50,000 crores of Capex. You are seeing there are companies like Concor for disinvestment, IDBI, Hindustan Zinc, Shipping Corporation, BEML. So those are the things which are going to happen now going forward. But the targets of disinvestment looks now very, very realistic now. In fact, when the government says that 48,000 crore of dividend will be received from PSU, this also looks very realistic. So that is very, very positive point actually, that the numbers are not exaggerated, they are under control. And that is where if any positive surprise comes, the markets also will take it quite positive because of the subdued numbers which are shown here. If you see the GST expectations, it is continuously increasing, and this is another prime revenue source for the government in the indirect taxes, and this is almost now 3.2% of GDP. So this is where we believe that this is a big revenue source for the government, which is getting more sustainable at a higher level. So now in the month of January, we have seen almost 1.56 lakh crores of GST inflows, which is again second highest now. So the new records are being made in the GST numbers, and we are seeing that more individuals are getting added, because from October onwards, even more than 10 crore turnover corporates, it is mandatory for them to do the e-invoicing now. So that is the reason that more corporates, more individuals are getting added under GST. So this is something that market was in a fix whether it will happen or not happen, because the government had to decide between fiscal deficit and giving some social welfare kind of initiatives. So finally, government has done something for consumption. They have brought down the tax liability on those which are at lower the pyramid. And so that is how it is. So in the new tax regime, government is doing all of these lucrative things because ultimately they want everyone to shift towards the new tax regime. So that is made the default regime now. And but not only for the lower the pyramid. If you look at the HNI category, there the tax was almost close to 43%, but now it is brought down to 39%. So that ways, both the sides of this consumption, we have seen the government has tried to give something, and this is really good considering the fact that the fiscal deficit is maintained despite the challenging times. If you see the consolidation of the fiscal, the prudence is maintained because 5.9% is projected now for the next year, which is lower than 6.4% of financial year 23. And they have said that by financial year 26, it will be below 4.5%. So that is remarkable if the government is eyeing on the fiscal prudence, despite the fact that they have to do all this to drive the economy now going forward and amid the slowdown scenario which is seen actually outside. So when we look at the inflation across the world, obviously India's inflation numbers are coming lower than the world's average inflation. So you can see here, and that is one positive which is coming for India. When we were 6.9, they were 8.8, the world average. When we are at 5.1 now, in 2023, they were at 6.6. So that is where the interest rate trajectory in India, if the US interest rates are increasing, it may not be the same kind of extent, same sharp increase now. Even in the US, we are seeing that the overall inflation numbers are coming down, though still it is higher than their standard. But the interest rate trajectory possibly may be capping now after another 2-3 hikes of 25 bips. So India is the beneficiary, and I think that is where our bond yields have remained subdued in the last few months now. Government collections in excess of almost 1.5 lakh crores we have seen. This is really very good. If you look at the last 2 years, the revenues are exceeding actually much better. So it is coming because of all these factors which I discussed just now. So if you look at the previous years and now, it is definitely from the revenue part, the government kitty actually has improved. Financial year 24 gross tax revenues are expected to be 10.4% and nominal GDP growth 10.5%. So in financial year 23, you had a nominal GDP growth of 15%. Now it is around 10.5%. We still believe that again, this is a very pragmatic number because it is possible that if any positive surprise comes, you may see another 1-2-3% of surge in the GDP. But whatever projections are done on the basis of 10.5% nominal GDP, that is why it looks more realistic. If you look at the measures to address the current account deficit, which is higher, actually, it moved to almost more than 4%. But now the government has tried to bring it down. We have seen that they are going for the promotion of lab-grown diamonds in India. These diamonds actually they have almost 5% of total imports. They are trying to do this in India. They are trying to incentivize the people who are converting the gold into electronic gold. We have to see how many people comes into this. Still, it looks like that the Indian families, they generally don't come actually or they don't want to show the gold outside. So that is where it looks dicey that how many people will come into this. But the reduction of custom duty on mobile components and the TV sales, we have seen it will bring down the cost of mobile and TV also going forward. And this is done because to give manufacturing push in India, they want to bring down the component cost which is used in the manufacturing in India to make our products more competitive actually. The subsidy bill is reducing now. If you see, this is very interesting number. If you see here, the food subsidy was budgeted for financial year 23 as 2,06,831 crores. The actual numbers were higher. Because of the war, we saw the wheat prices moved up and so many vegetable prices moved up. So the government also had to increase the subsidy, and it moved to 2,87,194 crores. But now the government for financial year 24, they have brought down this subsidy to almost 1,97,350 crores now. So if you look at the fertilizer subsidy, which was 1,05,262 crores budgeted for financial year 23, that also was increased to more than double to 2,25,262 crores. Why it happened? Because the fertilizer prices also moved up because of the Ukraine and the Russia war. And but now for 24, financial year 24, the government has reduced it by almost 50,000 crores to 1,75,148 crores. So this is where the overall subsidy actually is reducing now from the realized numbers of financial year 23. So the government has tried to give relief to one of the most negatively impacted sectors, MSME and agri. Higher inflation also impacted them. The pandemic also impacted them. So government now, through all the sources, they are trying hard to pull this particular sectors. So they are trying to give more allocation to MSMEs now. So 9,000 crore is infused to almost 2 lakh crores in terms of loans to MSMEs. 11% of increase to agri is given now, 11 to almost 20 lakh crores. And another thing is that government, is trying to digitize the PACS units in the villages. The PACS is primary agricultural cooperative societies. So the government is trying to digitize this so that the whatever is going to farmers, that can be mapped, that can be analyzed, and it can be done more correctly. So 63,000 units are there, PACS are there, which are government is trying to digitize them, and it will be total money of 2,516 crores. And so whatever the ways, I mean, you can look at the Kisan credit card, which is given to the farmers. We see the fertilizers, the seeds which are given to farmers, right? So many benefits which goes to them through this digitization of PACS. It can be made, more balanced and correct. That is the focus of the government. The Awas Yojana for this rural areas, affordable. Ultimately, they have increased by 66% to 79,000 crores. So all of this is towards, bringing this particular segment up because it was quite negatively impacted. So coming to certain sectoral impacts now of budget in the consumer discretionary segment, we have seen that the new tax regime has seen a lot of lucrative features in terms of the saving from the lower the pyramid segment and mostly. And so that is one segment. So that is one area which can bring the consumer discretionary, theme coming up now eventually. The PLI allocation for automobiles and components also stands at 600 crores now. Otherwise, previously it was just around, 10 crores. So it has increased substantially now from financial year 23. The electric vehicles also looks like that they may get little more cheaper, relatively cheaper, because the custom duty reduction is seen from 21% to 13% on lithium batteries now for these vehicles. CNG also looks like it may get cheaper with GST exemption on blended CNG now. So that is all, is likely to increase more disposable income for the people. More expenditure is going to come now towards the consumer discretionary. We have to pinpoint, we have to see in which pockets those flows actually are coming, and that is what we need to do going forward. If you look at the consumer staple segment, so because in taxes, in cigarettes, the taxes are increased. It was done actually for a particular NCCD 16%, but when you count the overall tax, it was only 3% of increase, and that is why we saw that the related stocks actually started performing now. So it looks like one of the major overhang is over from those stocks. If you see the rural thrust, obviously I have discussed to some extent, but microfinance also is given the push along with Awas Yojana and the agricultural credit. The free food scheme of 2 lakh crores actually is there. So all of this is done actually to increase the rural area. Energy is one thing where the transition is happening. So green hydrogen has received 19,700 crores of outlay. And ultimately, the objective of the government is to make it 5 million metric ton by 2030. So from the financial, there was one negative for insurance to some extent. It looks like because the non-ULIP policies with annual premium of in excess of 5 lakh, they are actually the bonus and all which is coming from the insurance companies. It was made taxable now from the 1st of April 2023. If you look at the under 80C, obviously when the people are moving from old regime to new tax regime, we believe that the people who are buying insurance for tax saving perspective, that number possibly can reduce, and that is the reason that the insurance companies actually have come under pressure for the time being. The doubling of deposit limit for senior citizen is a positive step, and that is one thing which is actually good here. Otherwise, from the insurance perspective, we have seen that it is little negatively impacted. From the healthcare perspective, government is talking about an R&D centers of excellence setting up, where the more focus towards the R&D in pharma, that can be the priority actually now going forward. So this is something that the government is eyeing for. They are looking for an increase in budgetary allocation towards National Digital Health Mission also. So 22 new aims are going to be opened now. And this is where the healthcare focus of the government is clearly seen. So it's more than 6,835 crores now overall. That is the increase we have seen in the healthcare budget this time. When you look at towards the real estate, because there was again little negative for the luxury segments here, that the people who were selling a property and buying a new one. So previously the cap was 20 crores. But now the cap is reduced to 10 crores now for the deduction. And that is where some of the luxury real estate providers, they have come under certain pressure actually for the time being. Housing for all, that has remained the focus of the government. So that allocation actually has increased. So if you look at the utilities part, so we have seen that the government is focusing more on energy transition. So ultimately 4,000 megawatt of battery storage they have gone into, and Ladakh, which I discussed, that they are setting up now the 13 gigawatt of renewable energy plan over there. So that is all from the budget on various sectors. Ultimately, we believe that this was a good budget. This was a budget which was meant for capital expenditure, the budget which maintained the fiscal prudence, the budget which actually is likely to drive some consumption going forward. And but yes, volatility will remain because state elections are there, and market possibly can spend some more time now. We have already seen that markets are around 17,600, 700. We believe this 17,000 to 18,000 of consolidation can continue for some more time before the final breakout in the markets now. And that is where, if you look at from the valuation perspective also, then the valuations in the market are getting very attractive. We believe the 5-year average is around 18.5, 5-year price to earning average, and the market now is there. And another 200, 300 points of decline, market will be below the 5-year price to earning average. So it will be lucrative considering the fact that the dollar is topping out and the FI flows is coming into the value pocket. So I think that is something that we need to see. So that is all from our side, from the budget analysis perspective, from the sector impact perspective, and from the money flow perspective, how the things are shaping up now. And let me see if any query has come on sector specific or any other query on YouTube. So we have received a query actually on the cement sector, that what is the outlook of cement now from here. So cement, obviously, when you see more expenditure on infra, so 50% cement goes into infra and almost 50% goes into real estate. But real estate, we have seen that on the ultra luxury segments, there was little negative. But overall, there is a very high expansion which is happening in the cement sector. We are seeing in a certain companies are going for doubling the capacities in the coming years. And that is where the supply is higher than demand. There is a clear mismatch between demand and supply. And that is the reason what we are doing. We are focusing more on the companies which are material providers to cement now, because the OEMs can remain under pressure, but the material providers, for example, high chrome grinding mills, the companies which are producing this, and they are giving these mills to all the cement providers. So whether it is Anani Group or whether it is City Cement or whether it is Ultratech Cement or Dalmia Bharat. So all of them are getting, so that is where the major Capex beneficiaries are those companies which are the suppliers to these cement companies. So you need to find out the companies with a very high market share into a component which is going to be very vital for cement manufacturing. And that is what our focus should be going ahead. So these B2B companies actually are coming up much better now. So that is all from our side, and wish you good days ahead, good investment. And these market declines are again throwing good opportunities for your investment. Thank you. Thank you very much.